What's up, YouTube? This is literally my sixth attempt recording this video. I'm gonna do no edits on this. I am literally heated, but back to the video. Zoom video communications. We're gonna be discussing why the stock market crashed just yesterday, and companies such as Zoom, DocuSign, Dexcom, Datalog, possibly Apple, Tesla, AMD, Nvidia, so on and so forth. All these tech companies especially got hit the most. So looking here at Zoom, which was one of the best performing stocks in the market so far in 2020, fell about 6% after having more than 2% at points earlier in the day. So what you can take from that is in the morning, the market was opening, it was up 2%, and next thing you know, within a matter of seconds, it completely just dropped, and it dropped as soon as all the other companies were got hit as well. So obviously, this has to be some pretty big news. Something big happened, but companies as DocuSign, which have been demanded for its electronic signature service during the coronavirus pandemic, slumped 9%. Dexcom, maker of continuous glucose monitoring medical services by diabetes patients, suffered an 8% drop. Datalog sank 10%, just one of many software services companies caught up in the downdraft, which is honestly unbelievable and very unexpected. If you ask me, no one really saw this coming. Everyone thought that the market was just gonna go straight up, but at the same time, if you think about it, they kind of have to eventually have to have a little flat out point, or a point where they finally flat out for maybe for the certain time being, and then they'll probably either bounce back up or bounce back down. Usually tends to happen. Just keep in mind, the higher they rise, the harder that they fall. In the long run, stocks tend to rise in conjunction with the strength of their underlying businesses. That's why relatively few people have been surprised at the fact that high-flying stocks have been able to defy the coronavirus bear market and gain ground. Specifically, each of these companies has found tremendous growth opportunities in recent months, such as Zoom. They've had hundreds of millions of people using video collaboration for the first time in 2020. DocuSign has filled the void of creating by people not being able to meet in person and sign important legal documents through online. Dexcom has been monitoring devices that have been able to helping those that have diabetes keep helping those diabetes patients from having to visit treatment centers for assessments, and Datadog and its SaaS peer have been helped to give their enterprise clients the ability to make the most of the information they're collecting while letting workers be productive from remote locations. What's less clear though is whether the size of the stock price gains in these companies have been warranted. In the short run, what defines how much a stock goes up is popularity among investors and buying demand for its shares. Short-term moves rarely move in solely in one direction, which is inevitable. Zigs and zags to keep shareholders on their toes. Always be ready for volatility. Last but not least, investors who own these stocks for a while shouldn't let a day losses lure them away from long-term investment strategies. If you believe that Datadog, Dexcom, DocuSign, or Zoom will be an important player and growth in the future, then a significant decline like today is better a sign that you should think about adding to positions rather than taking away from them. There is no guarantee that stocks won't lose more ground on Tuesday, later this week, or during the rest of 2020. But if it's the business do well, then the big names and many strong tech stocks that make up most of the Nasdaq 100 should have further to climb. So what this means is more like companies such as Tesla, Apple, Microsoft, your main companies that move the most, the furthest, the ones that have the most popularity, and companies that you believe yourself will be here around for 20, possibly 30 years from now. Like me personally, I believe Apple is definitely gonna be here in the next 20 years. When I was much younger, when I was a kid in middle school, I thought Apple was the greatest thing ever around. All my friends had Apple, and I just wanted to have an Apple as well. Fast forward to 10, 15 years later, well, Apple's still around, and yet it's become a $2 trillion company, which is unbelievable. So if you see what I'm saying, is what you could take from volatility or always be ready for volatility. It's basically saying don't be afraid of a stock dropping like 10, 15 bucks. Like yesterday, the Apple dropped like 10, 20 bucks, which is honestly a huge move. And a lot of people will probably get scared and sell, right? But as an investor, if you believe in this company and you're investing for long term, you should take this as an opportunity to position yourself in order to buy more stocks and get them while they're cheaper, obviously, if this is a great company, it's good. It's just for a little shorter period of time. They're gonna bounce back even further and stronger than they previously did, which is the coronavirus was a clear example of almost all the companies doing so. At least all the worth good value ones that are definitely worth investing. And for those investors, I hope you got to experience that. I feel like you probably learned a lot from that, and will probably will become a better investor yourself if you get to experience all that. Um, so like I said, don't be afraid of investing. I mean, yeah, don't be afraid of investing. That means invest, don't sell. Don't be afraid of a little drop. Remember, you're not a day trader. You're a long-term investor. At least if that's what your goal is. But if we look here, the the bulls right here believe that the stock market bubble can continue to soar from some time to time. A number of reasons. Firstly, as mentioned in the earlier article, the US stock market is very much in a Goldilocks scenario, meaning the good news is good news and the bad news is good news. That's because there is no doubt that the US economy is experiencing a gradually recovery. So what you could basically assume from that is more like you basically almost hit rock bottom, basically. And once you've reached all the way to the bottom, there's only one way to go, and that's up. So, as long as the gradual recovery remains intact, the Fed will maintain its support for the stock market. The Fed's support has saved the US stock market from a further crash, matter of fact, supplying everyone with a stimulus check. However, if the gradual recovery changes into a strong recovery, investor optimism will rise and the US stock market will surge even more. The second bull scenario for the stock market is a potential vaccine for coronavirus. Recently, the Centers for Disease Control and Prevention told us that the U.S. states prepared themselves by November 1st for a potential coronavirus vaccine. That indicates that a COVID-19 vaccine may be here under 2 months. This supports the bull case for another stock market rally. Finally, conversations are still taking place around another stimulus aid package. Stephen Mnuchin, the U.S. Treasury Secretary, mentioned this week that the U.S. economy needs another stimulus package for a full recovery to take place. Once we have more clarity on this and we get the green light for another stimulus package, the stock market will take as another positive sign. This could continue to balloon the stock market bubble, and for the bears case, the reasoning for a stock market crash is basically the failure of all the bull cases discussed above. Firstly, if we do not get another stimulus aid package in time, the economy recovery will remain fragile. Second, there is a fair amount of hype around a potential vaccine, and any disappointment on this front is likely to make the coronavirus stock market rally more uneven, which could trigger a stock market crash. So, in other words, what this basically means is that since there's so much hype or there's so much talk around going the vaccine, that there might be a vaccine or as well as a stimulus package. If in any type of shape or form, these will actually kind of help the economy. But if we were to announce that we're not giving them, we're not giving them out, this could possibly affect the economy, some shape, type, or form. Meaning, as in people's opinions might change, uh, as well as they will probably If they announce a stimulus package, some people might be like, "Oh, I'll just invest my stimulus package." And what if they announce turns out we're not? Well, that might withdraw from an investor from investing, for example, or that might make an investor salty or mad, you could say. So it all it's all of like you first mentioned, a Goldilocks scenario where the good news is good news and the bad news is good news as well sometimes. But overall, the bottom line is that there is no denying that the current stock market rally has gone too far and too fast. There is potential for correction, but a full-blown stock market crash for now doesn't seem to be imminent. So, in other words, it all depends on us, just like we have been doing from the start, as in when the coronavirus happened, we've all been playing our role, as in 6 feet apart, keeping being sanitized, wearing our mask in public, sanitizing the area, closing down places for the time being. Everyone's played their role, so it's not just the government plays the role, and we expect them to fix everything. So it's all of citizens play the role, government plays the role, and with this, without a doubt, everything should be fine at the end. But that'll be all for today, guys. Make sure to y'all drop a like, comment down below, and subscribe. Thank you very much, and you have a great day.